Hi there, Evan here with Crypto and Markets for Friday, March 23rd, 2018. Markets got absolutely killed yesterday. In China, the industrial metals all got killed overnight. Rebar, iron ore, zinc, nickel, rubber, you name it. They all got slaughtered last night. Of course, you've heard it all over the media, the US China trade war. I even did a previous video on that with the steel and aluminum tariffs. Now, there was a lot of exemptions that the US put on the EU, Canada, Mexico, Australia, Argentina, Brazil, South Korea. There were a few others in there as well. Of course, I think it was a good move on their part in that those tariffs were put on a lot of countries that the US didn't want to piss off, so to speak. But anyhow, and then China announced overnight the other way that they're putting about $3 billion worth of tariffs back. They're increasing the tariffs on pork and on U.S. steel and aluminum imports. Again, a lot of people thought that soybeans would be in there. The soybeans are one of the main exports into China. Amazingly, they weren't. But again, what caused the market decline yesterday, I don't think was the tariffs. I think it's something worth keep paying attention to. But in my opinion, I don't think it's what caused the sell-off yesterday. I'll state that honestly right there. But this right here is the most important chart of the market right now. It's the 3-month LIBOR, which is the London Interbank Offered Rate, what banks around the world use to lend to each other, used in many things, mortgages, credit cards, car loans, business loans, you name it. This is the rate they use to lend to each other to, in essence, fund their day-to-day operations, essentially. And then it's the overnight index swap, which is swaps that are based on central bank rates around the world, like the Fed funds rate, the Bank of Canada rate, the Bank of England rate, etc. Look what happened yesterday. It got over 50 basis points. Now I know you're going to say, Evan, this isn't that much. But we had a couple of bump ups in 2012. We had a bump up early in 2016, but it never got above 50 basis points. Why is that a magic number? Here's the last time I got over 50 basis points. And you want to know what Bloomberg does? This is Bloomberg's chart, honestly. You want to know how Bloomberg doesn't want to put fear into anybody? They cut the chart off in 2009. So they don't even mention 2007 and 2008 when doing this chart. See where the media stands. But anyhow, on a 3-month basis, which is what this chart is, by the way, this is actually on a 3-month basis. So 3-month LIBOR, 3-month overnight interest swap, where it stands on that. Here's the last time it cleared 50 basis points. That's right, mid 2007. And that was a start, of course, of one of the great bear markets the world has ever seen. Now, again, what's triggering this? As we all recall, the ECB in 2012, the Federal Reserve in 2009. It was all this quantitative easing to prop up the markets. The Federal Reserve bought mortgage-backed securities, bought corporate bonds, bought back even U.S. Treasuries because they wanted to keep interest rates low, force money back into the system, and force banks back into lending. Now, what do we know after that? Of course, mortgage rules got tighter because, of course, the U.S. had a lot of the same traits that Canada has now, to be honest. with the no income verification loans. I mean, I know it's not to the same extent, I realize that, but anyhow, that is what was going on from about 2003 to 2007 in the US. So mortgages were subject to tighter lending rules. That of course corporations were part of the QE program as well. So a lot of their bonds got bought up, and they were able to borrow at record low interest rates, and then buy back their own stock, which has propped this long stock bull market we've been in effectively. So all I think that's happened here was the the bond bubble that was there and that blew up in 2007, 2008 on the mortgage backed security side just spread into other things. Because effectively, they were buying up everything, trying to get money back into the economy. And a lot of corporations, of course, use this cheap debt to finance stock buybacks. More on that in a minute. And another thing that's definitely a worrying sign as well is government bond rates have gone up around the world. Because remember, guys, there's a lot of countries that have a serious debt problem. I mean, a lot of countries in Europe still have debt to GDP that's over 100%. The US has a debt to GDP well over 100% now. I think it's something like 110 now, I believe. And then, of course, corporations have borrowed a record amount of money. A lot of it going into stock buybacks again. Another worrying sign there, of course, because if they aren't buying back their own stock anymore, that's going to obviously have negative implications for the stock market. So, in essence, where do I stand on this? The bubble just spread from one group of bonds into other bonds. That's really all this means. And here's another chart, too. Compare the S&P 500 to the Nikkei going into 1990. Starting from about, I would say, the beginning of 2016 even. So 2016 is in essence 1988 in Japan. 2017 is 1989 in Japan. And then 2018 is 1990. And we obviously all know how the Nikkei did effectively in 90 and 91. Look at that chart, guys. Again, with central banks taking the band-aid off as quickly as they are. And let's face it, the world is just not ready for higher rates. I mean, super low rates is what drove this whole thing in the first place. And when it reversed as quickly as it did, it obviously caught a lot of people off guard. From the stock side to the bond side, even to the commodity side, etc. So yeah, things definitely don't look good out there. I'll just leave it at that. Anyhow, this is another chart that came across yesterday as well too. Now it's a little more complex. For my home gamer crowd there, I won't go as much into this. This is the option adjusted swap. The top line is for investment grade corporate debt. The bottom line is high yield. If you notice, high yield really hasn't caught up to the investment grade side yet. And of course, a lot of the companies that were investment grade were the ones that were using the corporate bonds for the stock buybacks. What this really means is people don't really see a slowdown still of any kind. This kind of tells you that the markets are still shocked. Because with high yield not going up, see, it effectively means growth is still going to be rosy around the world. And in that environment, high yield does really well because, of course, high yield, the companies that are within the high yield indices effectively have a junk rating status. And their bonds would obviously do better in a strong economy, with the idea being growth gets better, they're then able to pay back their debt, and their interest rates go way down. That's the idea behind it, of course. You can see right here, guys, see that spread? The markets still even don't see it coming, even with it already down 10%. And on the buyback side, here's a correlation between investment grade corporate, the investment grade option adjusted spread. The last chart I just showed you with buybacks. You see the nice correlation here all the way up, and then a break in 2018. And this is kind of portending, if you see here, about a 10 to 15% drop in stock buybacks. And with that really being the number one thing that's propped up the stock market, you lose that, and it's game over. But as I mentioned in previous videos, the 3-month LIBOR or OIS spread, you're going to start hearing, I think, a lot more about this. If this keeps going up, it's going to portend a lot of trouble in a lot of markets. I'll just leave it here, guys. Like the video, comment down below, subscribe, y'all take care.